I want to show you something strange. Right now, thousands of investors are staring at SpaceX's stock price, celebrating every green candle, every new high, every headline telling them they've finally gotten access to one of the most anticipated companies in history. But somewhere else, another group is watching the exact same chart for a completely different reason. They're not excited because the stock is rising. They're excited because every dollar higher creates a better opportunity for them to leave. And that's the part almost nobody is talking about. Now, before anyone misunderstands what this video is about, let me make something clear. This is not an attack on SpaceX. As a business, SpaceX has accomplished things most companies can only dream about. It reshaped the launch industry, built a global satellite network, secured government contracts, and created technologies that competitors are still trying to catch. The company itself isn't the question. The question is whether buying the stock today is the same thing as buying the business. Those are two very different decisions. Because sometimes an incredible company can become a terrible investment simply because of the price being paid and the structure surrounding the deal. And if you understand that distinction, you'll avoid a mistake that catches investors every IPO cycle. By the end of this video, I want to show you why the most important thing happening today isn't the opening trade. It's a series of dates hidden months into the future. And once you see them, you'll never look at IPOs the same way again. Let's start with a simple reality check. Whenever a company goes public, most people assume the entire company suddenly becomes available to trade. That's not how it works. Imagine a giant stadium with 100,000 seats. On IPO day, only a small section of those seats actually opens. The rest remain locked behind closed doors. That's essentially what's happening here. Only a fraction of SpaceX shares are available in the public market today. The overwhelming majority remain in the hands of founders, executives, employees, and early investors. And for now, those people can't sell. Not because they don't want to, because they're not allowed to. This restriction is called a lockup period. It's one of the oldest mechanisms in public markets. Without it, early investors could flood the market with shares immediately after listing, creating a wave of supply that crushes the stock price. So companies temporarily restrict insider selling. Sounds simple enough. But here's where things get interesting. Most IPOs use a single lockup expiration. One date, one release, one event. SpaceX didn't choose that route. Instead, it built a system that gradually releases shares over time. Think of it less like opening a floodgate and more like unlocking a series of doors. Each door lets more shares enter the market. Each door creates another opportunity for insiders to sell. And every one of those doors matters. Because supply matters. Far more than most investors realize. When people discuss stocks, they usually focus on demand. How many people want to buy? How exciting the company is? How much media attention it's receiving? How strong the story sounds? But markets are governed by two forces: demand and supply. Everybody sees the demand. Almost nobody tracks the supply. That's where mistakes happen. Let's imagine a simple example. Suppose a rare sneaker launches with only 100 pairs available. Demand explodes. Prices soar. Collectors rush in. Now imagine the manufacturer announces that next month, another 5,000 pairs will be released. Would that information matter? Of course it would, because future supply changes today's value. The exact same principle applies to stocks. Future shares matter. Future selling matters. Future unlocks matter. And that's why the calendar becomes more important than today's excitement. Over the coming months, additional blocks of shares become eligible to enter the market. Not all at once, but steadily, predictably, methodically. Each unlock increases the pool of stock that can potentially be sold. Now, notice something important. I'm not saying every insider will immediately sell. That's not how the real world works. Some won't sell at all. Some may hold for years. Some may buy more. The point isn't predicting behavior. The point is understanding incentives. Because incentives tell you what can happen. And in markets, what can happen often matters more than what headlines are discussing today. Think about who owns these shares. Early employees who've spent years watching paper wealth accumulate. Venture capital firms managing money on behalf of clients. Investors who entered at valuations dramatically lower than today's levels. For many of them, going public isn't the beginning of the journey. It's the exit opportunity they've been waiting for. And that's completely normal. That's how venture investing works. Capital goes in, years pass, liquidity arrives, money comes out. Nobody should be surprised by that. Yet retail investors repeatedly act surprised every time it happens. History is filled with examples. Not because the companies were bad, because expectations ignored basic market mechanics. The pattern repeats over and over. A company captures public imagination. The stock surges after listing. Excitement builds. Media coverage accelerates. Retail participation increases. Then, the lockup period approaches. More shares become available. Selling pressure rises. The narrative suddenly changes. And investors wonder what happened. Nothing happened. The calendar happened. That's the key distinction. Now, here's where another layer enters the story. Index funds. Most investors hear those words and immediately tune out. Don't, because this matters. A huge amount of money in today's market isn't actively managed. It's passive. Funds automatically buy stocks based on rules. Not opinions, not emotions, rules. Once a company becomes eligible for inclusion in major indexes, enormous pools of capital may be forced to purchase shares. Whether managers like the valuation or not, whether analysts think it's expensive or not, the buying happens because the rules require it. And when a newly public company increases its tradable share count, that process can become easier. Again, notice what's happening. You have one force increasing potential supply. You have another force potentially increasing demand. The market becomes a battleground between those two forces. That's why reducing the story to great company misses the entire picture. The stock market is never that simple. A stock can be fantastic and still perform poorly. A stock can be mediocre and still perform incredibly well. Timing, valuation, liquidity, sentiment, and supply all matter. Investing isn't just about finding good businesses. It's about understanding the environment surrounding those businesses. Now, let's talk about valuation, because this is where many IPO investors get trapped. When a company finally goes public, years of anticipation are already baked into the price. People aren't buying today's company. They're buying tomorrow's dream. The problem is that dreams can become very expensive. If investors assume perfect execution, massive growth, expanding margins, continued dominance, and flawless future performance, the stock doesn't need bad news to fall. It only needs reality. That's a dangerous position. Because reality is rarely perfect. Even exceptional companies hit obstacles. Projects get delayed, growth slows, competition emerges, economic conditions change. The business can still succeed, just not fast enough to justify the expectations embedded in the stock. And when expectations are elevated, disappointment becomes easier. This is one of the most misunderstood concepts in investing. A company doesn't have to fail for investors to lose money. It simply has to fall short of an unrealistic forecast. That's it. Now, let's return to the insiders. Because there's one group receiving a lot of attention, the founder. Many investors see founder lockups as a sign of confidence. And in many ways they are. When a founder commits to holding shares longer than everyone else, it sends a message. It tells the market they're willing to stay aligned with long-term shareholders. That's meaningful, but don't stop the analysis there. Because focusing only on the founder can distract investors from everyone else. A company isn't owned by one person. There are employees, executives, private funds, early backers, institutional investors, all with different goals, all with different financial needs, all with different timelines. Some people are building empires. Others are simply trying to realize gains after years of waiting. Neither motivation is wrong. They're just different. And understanding those differences helps explain why lockup schedules matter. The market often celebrates the founder staying locked in. Meanwhile, it ignores the dozens of other stakeholders gaining opportunities to sell. That's like focusing on the captain while forgetting the rest of the crew. The complete picture requires both. So, where does all of this leave an investor today? Not where most people think. Because the goal isn't to become bearish, and it isn't to become bullish. It's to become patient. Patience is one of the few advantages individual investors still possess. You don't have quarterly performance targets. You don't have clients demanding immediate returns. You don't have mandates forcing capital deployment. You can wait. And waiting is incredibly powerful. The market constantly creates pressure to act. Buy now. Sell now. Don't miss out. Last chance. Once in a generation opportunity. But history shows that extraordinary businesses usually remain extraordinary businesses 6 months later, and 12 months later, and 5 years later. Missing day one rarely determines long-term success. What matters is the price you pay and the information you possess when you pay it. Today, investors are operating largely on anticipation. Over the coming months, they'll receive something more valuable: evidence, actual earnings reports, actual public disclosures, actual operating results, actual market reactions. Speculation gradually gives way to reality, and reality is where intelligent investing begins. That's why the smartest thing you can do may be the least exciting thing you can do. Watch. Observe. Track the unlock schedule. Follow the earnings reports. Monitor insider activity. Study the valuation. See how the story evolves once the initial excitement fades. Because eventually, every IPO reaches the same destination. The moment when the narrative stops driving the stock and fundamentals take over. That moment always arrives. The only question is whether you're prepared when it does. And that's the lesson that extends far beyond SpaceX. Every future IPO will come with headlines. Every future IPO will come with hype. Every future IPO will come with experts telling you why the opportunity can't be missed. But buried beneath the excitement are always the same questions. Who can sell? When can they sell? How many shares can enter the market? What expectations are already priced in? What assumptions must be true for today's valuation to make sense? Those questions rarely trend on social media. Yet they're often the questions that matter most. Because successful investing isn't about reacting to the loudest information. It's about finding the information everyone else ignores. Today's stock price is loud. The headlines are loud. The excitement is loud. The mechanics are quiet. The lockups are quiet. The disclosures are quiet. The calendar is quiet. And over time, the quiet things usually matter far more than the noisy ones. So before you make any decision about SpaceX or any IPO, remember this. The opening bell is an event. The real story is a process. One lasts a day. The other unfolds for months. And investors who understand the difference are usually the ones still standing when the excitement finally fades.